Welcome everyone. Thanks for joining this morning's IDB. I think we've got 24 people in now, so I think we'll kick off. What I thought we'd do this week is a macro IDB, is kind of reflect on the juncture we are at in for markets, but also for the real economy. Clearly, from April onwards, we've had a fairly sharp recovery in markets. From May onwards, we've seen this sort of similar in terms of kind of an economic rebound in the data, but then both towards the end of the third quarter have started to stall, and we saw weakness in markets, and we saw kind of as I say, reaching this fork in the road for where we go next in terms of the recovery. So today I thought we'd kind of look at that and unpack through some of the reasons and the factors that are going to dictate the direction of the recovery from here. If you have any questions, just jump in at any time, please feel free. So start off, we'll have a quick recap. This was covered in Sanjay's most recent IDB. But in the second quarter, we've had a sharp contraction of growth, globally falling something in the order of 20% on quarter on quarter. And then subsequently in the third quarter, we're heading towards a significant rebound. And that's going to leave us quite well short, and you can see that from the first chart there, that certainly in the developed world, that just doesn't get us into a position where the recovery is complete, but where a lot of progress has been made, and this recovery is certainly well underway. From a regional perspective, I think it's probably worth highlighting that China, who were the kind of first in, first out, they look set to complete that recovery and to put their economy back on track to where it was at the end of 2019. Whereas Europe, the UK, we've suffered the largest contraction, and our subsequent recovery has been one of the weakest. But nevertheless, this is still a significant rebound through the quarter. At a sector level, on the second chart, and when we look at global activity, we can see that manufacturing output here fell very sharply, but that's where we've seen the significant rebound. It's been in services, which didn't suffer quite the same contraction as manufacturing, but subsequently it hasn't also benefited from the upswing we've seen in the global economy. It's been very much a manufacturing goods-led recovery, and part of that's for obvious reasons. Now, in terms of the surprises that we've seen, and this is the global economic surprise indices that track not the absolute level of data, I've said this before, but the positive or negative surprise versus expectations. And obviously with such volatile numbers, such large numbers as well in terms of the contraction and subsequent rebound, we should treat this a little bit as a pinch of salt. But what's clear is that in the third quarter, we've seen very significant upside surprise. So, and indeed, expectations have been managed to a point for the second quarter, actually, where the contraction in the end wasn't quite as large as many people feared. So we have seen, some really positive numbers, surprisingly positive numbers through the period. Although we have to, as I say, treat that with a slight pinch of salt, given that it was a very noisy period dealing with very significant changes in levels of data. And finally, then just in terms of the recap, you can see, I mean, this is a recovery tracker that Oxford Economics produced Well, this is just for 50% of the global economy. There are some key countries missing there at the second, so China and Japan and the UK. But overall, it gives you the feeling that we are 80% there when we're looking at things like mobility, output, consumption, all of the things that send us back to normal in terms of the recovery. But clearly, it's incomplete, and arguably the last 20% is where we're going to have the difficulties. And I've listed the three things I wanted to touch on today at the side there, which is that first of all, those difficulties are around, how do we fully unlock, how do we progress from here with regards to the health crisis and the complications that's going to raise. The visibility we're now seeing around kind of the lasting economic impact of closing down economies and reopening, and how that's going to be a drag from here on out in terms of the pace of the recovery. And then lastly, the ongoing, the renewing of the fiscal commitment that we've seen. I think that's going to be also pivotal in either cementing the pace of the recovery and making sure that final 20% is delivered, or potentially even setting us back. That certainly could be true. So this isn't necessarily about pointing out risk factors that are all going to be necessarily pessimistic. I'm trying to be realistic. These things could either propel us forward or could set the recovery back a little. So the health crisis, obviously, where it all started. Obviously, when we look at this chart, which is the number of new cases, we have to bear in mind that detection of new cases is a lot better than it was, and the tracking of them was a lot better than it was during March and April. But nevertheless, we can see that during September, we have seen globally an uptick in the number of cases that are taking place. So this idea that people were concerned about a second wave, what winter could bring, is definitely very real. And we've seen that obviously in the UK in the last 24 hours about that coming back to impact our lives. The good news is that at the moment is that whilst you're seeing an increase in levels of infections, we're not seeing the same levels of fatalities, and at the moment we're not seeing the same sort of pressures on healthcare services. So that may give us some more leeway to keep economies open, but I don't necessarily think we should take that for granted. And the blue line there, which is the Google Activity Index, which we can use as kind of almost like a proxy for economic activity. You can see that there actually so far, even though we've seen increases in cases during the summer and then subsequently in September, we haven't seen that feed through into a notable sort of setback for mobility and for those activity trackers. But I think that again, drawing our own real life experience in the UK, this is really something that's going to come under pressure. And the stringency, the restrictions around kind of our activity are likely to increase. So, and that's the same kind of the world over. So on the left-hand side there, you have some stringency indexes produced by, actually it's Oxford University. And you can see that actually, in terms of after the initial top panel, you can see that after the initial increase in stringency, we've seen this gradual recovery taking place, and we haven't had any setbacks so far. Let's see, it's obviously going to be important to look at this data on an ongoing basis to get a feel for how much of a problem the health crisis is going to be in future months. But what's probably evident from the second panel on the right-hand side is that whilst we might not now be able to lift further restrictions, and we can hope for kind of the stringency of the existing restrictions not to be tightened, we're still living in a world where we're under certain conditions, and that's going to hamper economic activity. And in terms of how it feeds back into completing that economic recovery, it's difficult to see a world where we go back to normal whilst we're still living under this sort of pattern of restrictions and constraints. So the bottom line is that this thing isn't going away, and we're going to have to live with it for several months yet. So what's the good news on the virus front, on the healthcare front? Well, we're going to come into a difficult winter, and it doesn't look as if there is going to be any silver bullet, so to speak, in terms of resolving those problems. But when we look into 2021, the prospect of a vaccine, more effective treatments, etc., becomes a lot more real. So on the left-hand side there, you can see that there are a great deal of effort being made to produce a vaccine. We've got trials for several drugs now in phase 3, and that process for approval has been vastly accelerated. So what would have historically have taken probably a minimum of 5 to 6 years is now likely to take place in somewhere in the order of 15 months. So that's reasons to be optimistic. Unfortunately, unlike Donald Trump said recently, this isn't going to be momentarily, the delivery of the vaccine, but it is growing closer. If you can see that on the right-hand side there, this is some interesting data from Cornell University, actually, which is super forecasters. So these are people experts who have demonstrated some predictive capability around these sort of things, medical questions. And you can see that from early summer onwards, the timelines around the delivery of a vaccine in the US really started to improve. So back in July, it looks no better than a 50-50 chance really about whether we'll get one in 2021. Now it's a lot higher, and it looks as if we will get it somewhere in the middle of the year, most likely. I also would point out that actually, if you see where, in terms of the progression of the Q1 expectations, that they fell back in September. And that's probably no coincidence that the market also softened in this period, as that sort of pattern of improvement, that firming of expectations, bringing the vaccine kind of delivery forward, then was pushed back somewhat. So but that's the first issue. That's the first thing that's going to be pivotal and kind of completing this recovery and where we go from here. Second thing is this changing gear that we're seeing in the global economy. Now, obviously, if you've listened to any of the IDBs from anybody in the team recently, read any of the notes, you would have hear us spoken about the shape of the recovery and how we thought that there was going to be some lasting economic impacts to what was experienced. And for a lot of the summer, that wasn't particularly evident. And to be quite frank, maybe it's predictable. You saw a strong rebound, but it's only really in the most recent round of data that we're starting to see this gear shift, this change in momentum that we're carrying into the fourth quarter. So on the left-hand side, that's been picked up in the business survey data for September. You can see the sharp rebound, but then in September it's turned lower in the developed world. And if we're having to manage risks around the coronavirus, etc., then we should suspect that that's probably going to retrace a little bit further from there and disappoint on an ongoing basis. On the right-hand side, really, it's a reminder about that shape. That we've experienced the first part of the V, but this is incomplete. And really now we're going into that kind of flattening, as the tail of the Nike Swiss shoe, maybe you could refer to it as, where things become a bit more unpredictable, I think. Risks, as these scenarios point out, are certainly skewed to the downside. And it's where all of these issues that we're talking about now are going to become really critical. We'll see how hard these yards are, how difficult that last 20% is. So in terms of the economic data, one of the things that is going to be absolutely crucial in tracking and understanding how it's evolving, the recovery is labour markets. And on here, just as we saw with the PMIs, September started to show a kind of a pattern of slowing improvement. Well, actually it was evident that maybe arguably in August, but you can see on the left-hand side that after that very sharp loss of jobs in the US, 22 million jobs lost in that initial phase, we then had some fairly steep rebound where lots of jobs were added. But then in September, we added half as many jobs as that were added back during August. And the nature of that unemployment is changing as well. So we can see from the underlying data that the number of unemployed that are now classified as permanently unemployed is increasing. Those that are temporarily unemployed and we hope to coming back, that is changing, and that unemployment is becoming more persistent now. And then more broadly, when you look at other unemployment labour market data, you can see that those that have been unemployed for more than 26 weeks, they're starting to increase. The number of job openings, that's starting to fall again. And it's difficult to see that that we end this year with an unemployment rate much lower than 7%. I suspect 7%. Once we have all of those temporary workers run off, is where we end the year, and that's where these hard yards. That's when that unemployment is no longer temporary; it becomes more cyclical, and arguably some of it is now, at that point more structural, given that we've had this change in industries and accelerations of certain trends. I also think it's probably worth identifying that a lot of those unemployed, when you look at the underlying data, is in those low skilled and labour intensive areas. And in terms of the recovery and getting people back onto payrolls and back into the labour market, that's quite important, because it's in those areas that usually absorb quite a lot of the unemployment from other areas. So if you have a well-paid job, you might move into kind of as a temporary basis, or whatever it be, into a lower skilled area, more labour intensive area. New entrants into the jobs market, that's often where they get their foothold and start. And the absence of that, the wiping out of a lot of those jobs, will make it difficult to start to decrease unemployment from that 7% level. So we've seen this recovery. I think it also could be argued that the level of unemployment we're seeing at the second is possibly quite flattering to kind of the underlying vulnerabilities in the labour market. Reason to say that is that obviously it doesn't account for that 7% level, doesn't account for fewer hours worked, or those that are part-time unemployed, underemployed. If you stack up the number of people that are receiving benefits, claiming benefits at the moment, it doesn't reconcile to that 7.3% level of unemployment we're seeing in the US at the moment. So there probably is a more realistic number that's closer to 10% as it stands. And on the left-hand side there, you can see some modelling from the Peterson Institute, which they've made an adjustment. So what they've done there is they've added in some jobs, 800,000 jobs that were probably incorrectly classified. These people were classified as not in work for other reasons, and not necessarily temporarily laid off. So that seems as if they've been misclassified. But then it's also added in that very significant drop in the participation rate. So basically those 4.4 million workers who just gave up looking for a job and who are no longer counted as unemployed. So when you add those two things back in, actually you see, as they've termed, a realistic level of unemployment that's closer to 10%. And finally, in terms of how stable that level of unemployment now is, whether or not we progress from here is one question. Do we see further setbacks? Well, on that front, actually, it seemed as if the job situation, even for those on payroll, is still quite fragile. So this is some survey data taken in the US again, which highlights that even those who make it back onto the payroll, who came off that temporary leave, came back into employment, and when surveyed, 36% of them have been told that there is a risk that they are still going to be laid off again, and many have already been laid off. So it's a really sort of sensitive period, probably we all know from personal experiences. We see in the UK at the moment that with these programs expiring, etc., that the level of unemployment could be set back quite significantly if the real economy doesn't improve from here. So labour market trends are going to be critical. The second thing I wanted to highlight that I think is really quite pivotal to where we go from here is this rebound we've seen in consumption, and particularly in goods demand. This is really what's pushed the recovery so far to where we are. And we know that the consumer is such a big engine, and we've said it so much over the years, such a big engine of global growth, especially in the developed world, that we need to see that in a healthy state in order for that recovery to continue and not face setbacks. Now, on this front, when you consider the virus concerns, when you consider the labour market concerns, it's not surprising that consumer confidence hasn't rebounded very significantly in the US. I mean, we have seen some stabilisation, but you probably think this is subject to some reversal given the issues that we're picking up through September. So the ongoing level of consumption, we've probably got to be a little bit cautious towards. I also think that the type of consumption, I mean, this is my own personal opinion, the type of consumption that we've had and the rotation we've seen from services through to goods consumption, particularly durable goods consumption, might not be very persistent. I mean, if you've been in any client meetings with me, you'll probably be sick of my stories of how I no longer go to the gym. I bought some little bits of gym equipment from the online. I won't be buying that again, and I won't be going back to the gym for quite some time. So I've substituted that services, that recreational services spending, with some good spending in the short term to cope with the virus, and that's not going to be repeated. It's a one-off, and I think that's taking place right across the economy. So whether or not you're buying garden toys for your children and you're not going to soft play centres, or if you're buying second-hand cars and you're not using public transport, or even if you see on the bottom right-hand side there, you'll see that there's very significant pickup in recreational vehicles spending. So these people are buying, from my interpretation of this, camper vans in order to get their holidays, rather than going on hotel vacations in the short term. Now, quite possible next year that they'll continue to use their camper van, but they certainly won't be buying another camper van. So when we look at this stage, I think we should be slightly wary about how persistent the bounce in demand is going to be.
Camper van.
You want to see the price of Winnebagos and the bounce in the share price. It's very significant.
It wouldn't fit in the London streets, Winnebagos.
Well, this is true. Maybe one of those VW ones. So kind of drilling down to that point a little bit more, how important services is to services consumption is. and also, in making sure that this recovery is persistent. You can see on the left-hand side that in terms of the makeup, the breakdown, 65% of household consumption is usually made up of services. And that's seen a very steep fall in the second quarter. Q3 data isn't available quite yet, but if we look at the services PMIs for September, that was where some of the most significant weakness was. And I think that something we need to be tracking quite closely to understanding how this trend is developing. It's probably worth reminding everyone, I have to remind myself, that we over recent years, we've often gone back to saying how services demand for consumers has been one of the really strong points of kind of even the weak spots in the global recovery post 2009. So it's very strange to see it set back for obvious reasons, the health restrictions and so on, but I don't think we can underestimate how important an engine it is for the ongoing persistent recovery. It'll also be, if we do see a rebound in services demand, it'll be important for the labour market and the weakness we've seen in particular areas there. And I say on cementing the recovery going forward. I think one key thing here in terms of the Chinese experience versus the developed market, or the Asian experience for the developed market experience so far comes down to services. So we've seen obviously China recover in terms of good demand, but also services demand as well. And a lot of that comes down to the fact that they have been a lot better at managing the virus and allowing restrictions to be continuously loosened to a point where that can recover. So we can use China as a kind of a blueprint for how these things could develop from here, how the recovery can develop. But we've also got to bear in mind that they've done a considerably better job in virus management. So skipping along, finally, so that's the kind of some of the lasting impacts on the economy and what we need to be tracking going forward. I think the last thing to hammer home is the importance of the kind of the fiscal spend, the renewal of the income support that's been provided to economies during the pandemic. So on the left-hand side there, you can see kind of the scale of the amount of support, certainly for North America and Europe, with salaries being substituted with benefits and subsidies, quite heavily over and above 50%. But elsewhere, the income support has been quite significant. And on the right-hand side, it tells us the same story really, which is that although compensation has decreased, personal disposable income hasn't decreased by the same amount. And that's because of that government intervention. And indeed, in North America, Canada, and the US, you can actually see that in the effort to make sure that money quickly got into the hands of households to prop up aggregate demand, that in fact actually personal disposable incomes went up during the period. And this is all to do with this unprecedented level of fiscal support that's taken place. Question is this going to be maintained? Can you extrapolate kind of that commitment for fiscal policy that took place, that do what is ever necessary mindset that was then there during the crisis into the recovery phase? And it looks initially that it's going to be more difficult. We see the problems that are taking place in the US in securing a second phase of fiscal stimulus. Not just the urgency to do it, but also the quantum that is being discussed. It's not going to be of the same level of support. But then also in the UK, the question has turned more to how do we pay for this, and how can we strategically target certain areas to support rather than kind of this wholesale bailing out of households. So what we're presented with, in my mind, is this a mismatch between how lasting the economic and how deep the economic shock is going to be, and how lasting and significant the fiscal support is going to be. And I think Sanjay referred to it in the last idea as this idea of a fiscal cliff, certainly in the US. And we've already seen incomes start to fall. So in the last monthly data in the US, incomes fell somewhere around 2.5%. And this threatens to send this recovery backwards. And without dwelling on the point too much, this again is impacting lower income households more. So we saw those people in the labour market trends. We saw low income, labour intensive jobs the most at risk in this recession. These are the households that have been supported the most during the crisis phase, and therefore have the most to lose, are going to be most penalised if these fiscal measures are prematurely tightened. So food service worker, without the support on the left-hand side there at the top, without the support, their salaries, the median earnings would have dropped by 50%. With the support, actually, their median earnings grew, actually 175% of what they were previously. So very significant in terms of how steep that cliff drop could be. But on the right-hand side there, I have the US savings rate. Clearly, the fiscal support has been significant in sort of propelling that consumption rebound. If we don't get that kind of continuation of fiscal support, there's a good chance that we can limp through Q4, drawing on some of the savings that have been accrued in the period of lockdown, and that was the case in the most recent data. You saw the savings rates start to fall as they dipped in there to maintain consumption, but that can't continue forever. And if we get into a position where households, businesses experience this kind of psychological kind of damage around fiscal support, companies will throw in the towel with regards to employment, and consumers will lose confidence and will start taking more of that precautionary behaviour that could be damaging in the longer term. So that's the main body of the presentation today. The things that we need to be tracking and conscious about in the way forward, the risks around the health crisis, about the lasting economic damage, and around kind of the commitment deposit policy. Kind of the bonus section today is around US elections. It comes up time and time again in client meetings. I'm sure you're all experiencing it. So I thought I'd just drop in a few slides, a few comments on that before we conclude. So how do we stand? Well, if we look at the polling data and indeed actually now the betting markets, it looks as if Trump's path to victory it seems pretty narrow at the moment. And what's been interesting is that the polling data has consistently showed quite a wide margin or a healthy advantage to Joe Biden, but the betting markets and indeed financial markets through kind of investor surveys haven't been as convinced. And it's only recently, since September, that the two have converged. It was always looked probably likely, but the two have converged on the kind of the view that Joe Biden has a clear margin now. And when you look at some of those places where Donald Trump is struggling, he's losing in the vast majority of those key swing states, places like Florida, where he was campaigning last night, where his messaging, his handling of the coronavirus has gone down particularly badly. So things don't look good for the Donald. I would say that if you look back to where he was polling in 2016, it's not a too dissimilar kind of difference between himself and Hillary at that stage. So lots of things can change, and this is clearly a very volatile environment. But let's see. We're closing in on just over 20 days now, and the margin is still quite great. maybe the more important thing that comes out of this election season then, and also in terms of influencing what sort of policies we'll see in the next 4 years, is how the Senate race develops. And what we've seen here is the Republican majority is in some kind of jeopardy. And more recently, actually, as you can see on the left there, the Democrats are now, it's a toss-up, it's too close to call, but certainly the Democrats looks as if they're kind of got their nose in front. And this is, as I said, important to kind of the legislative process around policy going forward, and how likely Joe Biden, as a new president, would be able to deliver his policy agenda. So it does seem as if in those 4 boxes on the right-hand side that we're likely to see one of the first two: Joe Biden presidency with either a Democratic Senate or the Republicans holding on. One thing I would say is that Democrats might not win back the Senate this time round, but in 2022 it does look as if the odds are considered to be more stacked in their favour. So it might be for the first couple of years that Joe Biden doesn't have a Senate majority, but that in the second 2 years that he could well do. I mean, that's because there are a lot more Republican seats up for renewal. A lot of those seats are very close, and you have some long-standing senators have already said, Republican senators have said that they're not going to seek re-election, and on that basis, it makes a new candidate's, Republican candidate's position more difficult. So how do their respective policy agendas stack up? I think probably the best way is to kind of appraise this, evaluate this, is to look at whether there's overlap and whether there's significant differences, and what kind of the net consequences are going to be. So in terms of overlap, I won't go into all the detail on the left, but both candidates are going to push for a fiscal boost and significant uplift in infrastructure spending. So in that respect, it's similar to 2016 with Clinton and Trump. This always looked like it was going to be on the cards. Both candidates are supportive of US manufacturing, so that process of bringing back some of those those manufacturing bulk jobs back into the US. And both candidates are going to remain quite hawkish, I suspect, on China, and that's definitely with polling and survey data. It does seem as if American attitudes towards China have changed very significantly. So I don't think that we're going to see any significant let up from a Biden White House on China. Where they most significantly differ in their agendas is, first of all, the tax situation. Joe Biden would increase corporate taxes, not back to the level where Donald Trump took them down from, but would take them from their present 21%, I think it's 28% he's eyeing to increase corporate taxes to. And similarly, he will push back on some of the individual Trump tax cuts that Donald Trump made. And so for the highest earners, you're going to see income tax increase. And for the very highest earners, you're going to see kind of maybe an equalization of capital gains taxes with income taxes. The other area that is important to kind of development of economic conditions, I think, is the clear divide in their regulation outlook and their attitudes towards the environment, but then also trade policy with allies. So on that front, we're going to see Joe Biden reintroduce some of the regulations that Donald Trump has rolled back, particularly environmental. And you'd expect to see a far more cordial relationship with trading partners such as Mexico, Europe, UK, Canada, some of those, and also support for institutions that Donald Trump has kind of really turned on their heads in recent years. What's the net kind of impact of this? Because obviously, you know, for instance, some of the Biden policy pledges are positive for growth. Some may be less supportive, particularly regulation, etc. Well, I've seen a variety of forecasts on this, and those that I have from Citi down the bottom are probably the most optimistic, which is that either there is very little difference between the two candidates in terms of their growth impulse and inflationary impulse, or marginally over time, Joe Biden in the next few years could see growth levels of growth uplifted. But I think really here the conclusion is that yes, we will see some policy differences. A lot of those policy differences might not take place because of how the Senate is stacked up, and possibly the most growth positive things around fiscal spending and infrastructure spending, both candidates are pushing for. And finally, clearly this is an election like no other. It's in the lead up, it's been highly volatile. The country's, the US is particularly divided at the moment for lots of reasons. Expectations around mail-in ballots and fraud, and this idea that regardless of the result on November 4th, or the expected result on November 4th, it's going to be contested, and then you're going to have a protracted kind of legal battle, court battle around, most likely around the mail-in ballot situation. Now, I think that the key thing here is just to point out is that the market is certainly primed for this. And we can see in this chart that the implied level of volatility for S&P options shows that from election day onwards, right through to inauguration day, there is a higher level of volatility expected. If indeed actually the election result doesn't lead to any contest, or maybe even if the gap is so wide that the result seems even inevitable, regardless of the contest, that the market can breathe a sigh of relief. That we see kind of risk deflate, and those levels of implied volatility start to fall out again. So we shouldn't necessarily expect all the worst things after from November to December. In terms of kind of the market impact, we're already starting to see a sort of a backup in yields, starting to price the probability of this blue wave that people have obviously read about, and also the sort of the more Biden-centric agenda. And we've also seen that start to weigh on the dollar a little bit more as well. Arguably, the most dollar negative outcome for this election season is a Biden presidency and a Republican Senate that can curtail his corporate tax ambitions. But nevertheless, I think that a clear victory with either policy agenda set out by Joe Biden or Donald Trump will continue kind of this reflationary process, and that will be a dollar negative eventually as we come through. So just to summarize, because we're getting up on the hour. Yes, we've seen a strong rebound, but it's incomplete. And momentum, we're seeing a gear shift as we get into Q4. The three things I think are important, obviously, first of all, in creating that gear shift, but then also in kind of re-accelerating the recovery, are the management of the health crisis, how sticky some of those economic problems are going to be, particularly consumption and around the labour market, but then also the necessity to see kind of this fiscal policy renewal. If we don't see that renewed, it's very likely that we'll see a setback for the recovery. And with all this in mind, in terms of kind of how it feeds through into kind of asset allocation and investment decisions, well, there clearly is still a set of risks. Economic conditions are under pressure. You know, as I said, these hard yards are still to come, and this is against a backdrop of quite demanding valuations. So for the moment, we still believe that some amount of caution is still warranted. I've finished bang on the hour, so I'll open the floor to any questions if there are any. No questions. That means it was either really good or really bad.
It was really good, Matt.
That was really good. Thanks, Matt.
Okay. No.
Still looking at Winnebago's over here, so sorry.
Camper vans, I'm telling you, it's the way forward. Yeah.